Hi, I want to talk to you today about my friends at Bitwise and why they're the best crypto asset manager out there. So many investors I know are working with Bitwise today. They've got more than 20 products to help investors get whatever access they need or want. They've got a team of more than 100 across the US and Europe. They have more than $10 billion in client assets. It's not just the products that show they're all in. They've even supported the ecosystem by donating 10% of their Bitcoin and Ethereum ETF profits to open source developers. And they were the first company to publish their Bitcoin ETF wallet address. Like I said, these guys are true OGs. So please go and check out Bitwise. They really are excellent. Go to bitwiseinvestments.com and see all they've got to offer. That's bitwiseinvestments.com, or just email them at james@bitwiseinvestments.com and let them know that Raoul sent you. Anyway, there are a million ways to access crypto. Explore how you can access it best with Bitwise. And remember, carefully consider the extreme risks associated with crypto before investing. Anyway, thanks very much. Super AI. Everybody wants to know what's going on in AI. This has been the event to figure it out. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that all in one place in Singapore. What more can you ask? It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. Hi, I'm Raoul, and welcome to my show, The Journeyman, where I travel to that nexus of understanding between macro, crypto, and the exponential age of technology. Now, over my years in my macro investing, I've gone from being more of a value-based investor approach to a growth investor based around my everything code thesis. But markets are made up of many different strategies and different ways of making money at a different point in the cycle. We're at the point in the business cycle where many other strategies like small caps or value start to become more important again. Some may argue that we're on the cusp of a much bigger move in value-based investing. And so it's important for me to speak to investors who have a different point of view of my own. Now, I'm lucky enough, I have a big Rolodex and a lot of friends from the industry. So I get to talk value investing with one of the greatest value investors of our times, Mark Holowesko. And Mark's approach is very different to mine, but he's incredibly good at what he does. And I think you're all going to find a lot of informational value in how you can also make money out of the business cycle and whether there's a shift away from growth and to value. Anyway, I hope you enjoy my conversation with Mark Holowesko. Join me, Raoul, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together. Mark Holowesko, fantastic to see you on Real Vision.
Oh, nice to be here. Thanks for having me on.
Yeah, it's good. We're two different islands, not too far away from each other.
Yeah. But Island boys.
Island boys, exactly right. So, look, lots to chat to you about, Mark. But I think as ever, to go back in time and let people know about your career, how you started and how you got to where you are today, I think frames everything nicely.
Sure. Well, I grew up in the Bahamas. I went to high school, college, and graduate school in the States. And that was back in the early 80s. Couldn't get a job in the big city of New York, so I decided to come back to the Bahamas. Worked for a trust company for a year, and then applied for a job with Sir John Templeton. And he initially turned me down, which was disappointing. And then I thought, geez, I'll get him to sponsor me for the CFA exam. Back then, maybe it's still today, you need a CFA to sponsor you. There's only 2 on the island, thank goodness. Sir John and a woman who was a professor. Anyway, he sponsored me for the exam. A year later, when I passed the first level, I wrote him back, said, thanks a lot. He invited me in for an interview and offered me a job. And that was sort of the beginning of a wonderful career for me. So I started off here in the Bahamas working as a research grunt for Sir John Templeton. It was Sir John, myself, 2 secretaries, 2 accountants, and a receptionist in a small office in an attic over a shopping center. And we ran, one of the one of the most famous global equity shops in the world in an attic. It was really quite something until he decided to sell the business. He sold it in 92 to Franklin. And a couple of years before that, he built an office building so he could get a better price on the sale, I think. And I was the head of global equity for Templeton, ran Templeton Foreign Fund and Templeton Growth Fund. And then in 2001, decided to go off on my own and started my own company that basically manages long only and hedge fund money for a small group of clients.
What was John's style like, and what did you learn from John, and how did your style differ over time?
Sir John was, an absolutely fascinating individual. I mean, he was a true contrarian. Everyone said Sir John was a great stock picker, but Sir John was also a fabulous market timer. And his style was a bit strange. When I first interviewed with him, he showed up in pink pants with a yellow jacket and suspenders, and he had butterflies all over the wall. And I thought, this is a sort of a different situation. And being in the Bahamas, I think he was so isolated, he could sort of think independently. We didn't have the internet back then. We didn't even have a fax machine when I joined. He was still using a slide rule when I joined him in 85, which was, it's a little bit scary for me because I'd forgotten how to use my slide rule. And he was very sort of cost conscious person, not only in terms of how he ran money, but in terms of how he ran his life. Never bought a new car till he turned 80. Used to use hotel stationery because it was cheaper than buying loose leaf. If the most excited I ever saw him was during the crash of 87, probably because he'd given me all the mutual funds in May of 87. But, he sort of loved problems in the market. And what I learned from him more than anything else is try to evaluate problems. And so one of my first jobs with him was to try to evaluate the Union Carbide explosion. I don't know if you remember, in Bhopal, India.
That's right, yeah.
And I still sort of get tingling thinking about it because it was, just incredible disaster. But for him, what does it mean monetarily? And try to put a price on that for Union Carbide and look at that relative to how the market reacted. So I guess he taught me to remove emotions out of the equation and add, calculations and try to take advantage of adversity as much as you could. And so he was a true stock picker with a market timing bend to him, but he made most of his money taking advantage of problems around the world. He wasn't a growth investor, that's for sure.
Hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now. No, he was also famous for being an emerging market investor as well. So he would look for value where he saw value, and it could be anywhere in the world. He was kind of indifferent.
Correct. In the early, he got in Japan before Japan became popular. When I joined him in 85, he was sort of getting out of Japan, but he had been in Japan for, 10, 15 years. He got into Mexico early. Back in the 80s, there were only, 10 or so countries that were considered emerging markets that you could actually invest in. But yeah, he was one of the first true emerging market investors. Unbelievable, fascinating man, incredibly humble. He wrote a book called The Humble Approach. I sort of used to joke with him because if you looked on the inside cover, it said by one of the world's greatest investors. And I said, Sir John, I'm not so sure about that. But it was a truly humble man. He was not great one-on-one, but he was phenomenal in front of 5,000 people.
Wow.
And so even though I worked, my office was right next to him, and I worked more closely with him than anybody for 15 years before he sold the firm. It was hard to get to know. He was a very quiet individual. And rather than walk in my office and say hello and, would you do this or do that? He'd write it on hotel stationery and come in and put it on my desk and walk out. And I'd look at it and work on it for a couple of days and walk into his office and put it on his desk and walk out. And, when you show you what sort of individual he was, he paid me by the hour. I had a master's degree. I was getting my CFA, but he figured a young guy like me should work so many hours a year. And as long as I was on pace to do that, he didn't care, how I did it. He paid me by the hour, and I was hired in May. In September, I came to work. Little envelope on my desk. I thought, geez, it's not working out too well. But the letter said, due to your hard work and diligence, I'm happy to raise your salary by $1.50 an hour effective September 1st. So that was my first raise, $1.50 from the great Sir John Templeton. It got better after that, but it was.
He was always a value investor.
He was going to underpay for my work effort, but it was fine with me.
So when you then built your own firm, what's the vision? I mean, I remember it because I was at Goldman with your brother at the time. What was your vision that you wanted to build yourself? Because you're free of Franklin Templeton, you're free of Sir John. It's now Mark and Mark's own thing. What was your vision?
Right. Well, when I really wanted to transition away from what I was doing at Franklin Templeton. So Franklin bought Templeton. I stayed on at Templeton from 92 to 2000. I was in charge of the Global Equity Group, but I was also in charge of running the Templeton Foreign Fund and the Growth Fund. And both of those, when I left, were about 15 billion in size back in 2000. So they're very large funds at that time. But I was also in charge of the investment process. So I had, 70 people in 9 different locations around the world reporting to me. I also, was involved in marketing. And in these larger organizations, you just get pulled in so many different ways. I was on the executive committee of Franklin Templeton. I was on the board of the European
and
funds.
Could you do that from the Bahamas, or did you have to be?
Yeah, I did it right here from the Bahamas.
Okay.
That's where Sir John was based. He was based here in Nassau. And I just got to the point where I thought, I remember one Christmas, supposed to go, skiing and with my family for Christmas, and had used up all my days in the U.S. I'm not an American. I'm a Bahamian citizen. And I thought, this is crazy. I'm just on the road so much. So really, it was a lifestyle change for me. I wanted to basically focus on picking stocks and running money. I love doing that. I think it's so exciting to get in the morning, turn the machines on, look at what's going on around the world, evaluate companies. That to me is so exciting. What's not exciting is sitting in front of a 40-year-old analyst and they're crying because they have the wrong title. So I decided I wanted to start a company with a small group of individuals, a small group of clients, and we were going to focus on global equity, intrinsic value around the world, stock specific. Don't worry about the indices. And if I was lucky enough to have, enough clients that fit around a board table of, certain size, I'd be very happy. And we sort of have accomplished that. We never had more than 20 clients or 20 relationships. And most of my staff came with me from Templeton. And the goal was to run a global long short and a global long only fund and look out long term and don't worry about short term performance or gyrations and concentrate on stock specifics.
And your focus has always been with a value bias as well. You've not been a growth investor per se.
Well, if you'd asked me what I feel some of the things we've done wrong over the years is probably not paid enough to growth because, value should encompass growth at a discount. And it's been hard to justify some of the growth because it really hasn't sold at much of a discount lately. But yes, we've been value investors, so we've been out of favor for a while. But I strongly believe that trend turned when rates bottomed 3 years ago. And although last year, growth substantially outperformed value, I think it was because of the election. All the liquidity was thrown into the system. And that's an aberration from my perspective in terms of this turn we've had in value versus growth. So I feel we're going back to the pre-global financial crisis period where value did well and you had periods of growth outperformance. Post-global financial crisis, growth did very well with small periods of value outperformance. And I think that's changing.
So what is your macro backdrop currently? How are you seeing the world? And then we'll break it down into different kind of opportunities that you see out there or risks.
Well, I mean, there's so much going on around the world, as you know, from a macro perspective. But, I guess the biggest thing is that markets have been driven by abnormally low rates, abnormal liquidity, and big growth differentials. And within the United States, there's been big growth differentials between the Mag 7 stocks, the big dominant tech stocks, and the other 493 companies. And there's also been a big growth differential between the U.S. and non-U.S. markets. Most of the things that caused, I think, growth to really percolate to the extent it has, I think, are reversing. You're getting a removal of liquidity in the system. You're getting more normalized interest rates. You're getting central banks around the world that are unwinding their balance sheets until yesterday, which is a very interesting thing that I think happened yesterday with the Fed slowing that pace down. And you're getting governments realizing that they can't have 6% budget deficits as a percentage of GDP when the economies aren't, in trouble and unemployment's at low levels. And those are going to be reversed. So all this liquidity that was thrown into the system, when you have this much liquidity that was thrown into the system, it tends to find its way into financial markets. And to me, that seems to be reversing. And the other thing that seems to be reversing is a lot of the reasons why American exceptionalism was in place and why American profitability was so strong were low interest rates, lower tax rates, outsourcing. Those things are reversing as well. And we have, the added elements of tariffs, which created a lot of volatility. But from a stock picking perspective, all that is phenomenal. I mean, the more volatility in the markets, the better. I mean, this has been a great year for stock pickers so far, even though most markets are down. And I think most stock pickers are probably making money on down days because of the volatility that's going on. So I would say the biggest issue is liquidity is being removed from the system. And I also think that most people are anticipating that interest rates will go back to where they were post GFC, post global financial crisis. And I think that's totally misplaced. I think that, post GFC, we had sort of inflation 0 to 2%. It went up a little bit above that, but generally it was 0 to 2%. Prior to the global financial crisis, we had inflation of 2 to 4%. And that to me is a more normal range. And, interest rates were totally abnormal from the global financial crisis through COVID. Now, we're just not going to go back to that period. Most people who are in the business today have only experienced that, so they think that's normal. And they think going back to normal is going back to the post-global financial crisis period. And I don't see that. So I think we're in for higher rates than most people anticipate. I think we're in for less liquidity in the system. And if you have higher rates, you have a higher cost of capital. That's good for value stock pickers.
And do you see the kind of unbundling of the global economy, Trump's idea of, the re-regionalization of the global economy is another opportunity set. So we're not as global as it was, the same capital doesn't flow around. So therefore you're going to get more specific opportunities, let's say in the US or in other countries, as people kind of retreat back to their own home ground.
Look, I think some of the retreating back to your home ground might be forced. A lot of governments around the world, have budget problems as the United States does. And a lot of governments or a lot of countries around the world support the U.S. in terms of funding. And I think some of that funding has to go back to home countries to support the fiscal needs in those countries. So Russell Napier, who you might know, has done some great work in this area, talking about how capital might be forced home. And so I would agree with that. But I think that as a money manager, the most interesting thing to do is to not try to predict what's going to happen, but try to look into the market and say, what is the market saying will happen and where you have the biggest disagreement. And, tariffs are a great example. All these auto tariffs that are going in place, if you look at some of the original equipment manufacturers in the auto space, one of the companies that's hurt most by tariffs is General Motors. I mean, General Motors, I think something like 40% of their cars are produced in Mexico.
Yeah.
Some of the producers like BMW that has a facility in South Carolina and Subaru that sells lots of cars in the mountaintops of Colorado. Even though those are foreign companies, they're not really impacted that much by tariffs because of where they produce and et cetera. So I think what you need to do is take a look at a lot of these issues that are going on around the world and say, what do stock prices reflect? What truly is impacted by it? But to your question specifically, I think capital will flow home. I think production might be forced back to certain home countries. And I think that's inflationary, quite honestly. I mean, General Motors pays $2.60 an hour for an auto worker in Mexico. They pay $26 an hour for an auto worker in the United States. If you force General Motors to produce more cars in the United States, that's a big difference in labor costs that they have to overcome. So I think the question you've asked, basically the response to that is that's going to cause higher costs of capital and higher rates of inflation.
Does that not force companies like General Motors just down the robotics curve, the robotics and AI curve, just because that is going to be the labor arbitrage of the future?
Yeah, very much so. We're doing a lot of work in that area today. The great thing about robots is they don't take coffee breaks and they don't get sick, and they can work 24 hours a day as long as you plug them in and you charge them back up. So absolutely. You look at the amount of robots now in Amazon's operations.
There's more than people, I think, now.
I don't remember the exact number, but I think it's like 700,000 or something ridiculous. And the cost of those robots and the productivity of them are quite high. So yes, I would agree with that statement.
And do those manufacturing businesses like robotics, do they offer value opportunities because they're more manufacturing based, they have a higher cost of capital, they're difficult businesses, than a typical SaaS style business that was the growth model? Do you find there's more opportunity in being able to leverage into this side of the equation?
A lot of the companies in robotics have dominant market shares. And so I can't name companies for different reasons, but there's a company that manufactures the joints for robotics. They have massive market share, and there are different ways of playing the robotics introduction in manufacturing. You don't always have to buy the companies manufacturing the machinery, but some of the component manufacturers that have dominant market share. So they tend to have very high cost of capital. You have to put a lot of capital in place to produce robotics. And the companies do have great market share, so they have generally good pricing power as well.
And what about the energy side of that equation as well? So that's the other big thing. If you go down to Houston now, everybody's realizing that data centers plus robotics, the whole thing is a energy renaissance is needed, and not just in oil and gas, but across everything.
100%. And, you could look at different ways of investing in that. I think the best way to invest in that is through natural gas. That's the sort of area we've been looking at. A lot of the more direct plays on that, some of the nuclear stocks, they've all run. But yes, I mean, there's generally when you look at data centers, when you look at the movement to electric vehicles, which although it slowed down, is still going to maintain a certain pace. The electrification needs in the United States are massive, and you have an aging electrification base. So there's a big need for that. But from our perspective, I think the best way to play that is by looking at the natural gas sector. There's some really interesting. That's the area that really has to expand and can expand quickly and doesn't have some of the environmental problems of oil and coal. So natural gas is a great way to play that need for electrification, I believe.
Isn't it a bizarre world that a friend of ours is now running the Treasury?
I know. He was at our conference last year, and very interesting guy. Very interesting guy.
Yeah, I mean, because he's had a place in Life of Key for a long time.
Yeah.
I mean, even in my house in Spain, who's a global macro investor, subscribed for a long time, and we were all in the same industry together. But what's interesting, what Scott talks about, is this desire to lower the cost of energy in the United States.
Yeah.
And I wonder how that plays out, in terms of who gets the margin, how does it work? We're not yet at the cost of production for shale, but if you start breaking $60, it starts to become a problem again. And I always find it a very difficult market, energy, to capture value.
Yes and no. I mean, I saw a graph yesterday that looked at dividends plus share buybacks in the United States by sector. And the sector that has the largest dividend plus share buyback by far is the energy sector. It's 7%. I think the next largest one was communications. Most of the other sectors were almost half that level. So a lot of energy stocks in America haven't really expanded capacity and haven't really spent the capex that they need to put the capacity in place to meet this future demand for oil and gas because of some of the regulations that have been in place up till now. And as a result of that, they've been generating huge amounts of free cash flow. And they've been returning a lot of that free cash flow to shareholders in terms of dividends and share buyback. So I actually would disagree a bit. I think there are some really interesting energy plays because they're giving that cash back to you as shareholders. But in terms of Scott, the new Treasury Secretary, I think the only way they're going to get energy costs down is by allowing companies to drill, this drill, baby, drill, and also expanding the usage of natural gas. I mean, it's the quickest way of meeting your energy needs is through natural gas. So I think that's an interesting way to play it. Another interesting thing about Scott, if you go back and read some of his old letters before he became Treasury Secretary, I kind of feel that it's better, according to what I read in some of his letters, to let the dollar weaken than to put tariffs on everything.
That's right.
And I think this idea that the dollar is going to be super strong and the U.S. administration wants a strong dollar, I don't agree with that. I think the dollar is certainly overvalued. The dollar is being driven by differential in yields around the world. Those yields differentials are narrowing. And I actually think Scott and the U.S. government would be very happy for the dollar weaken. That would take some of the pressure off of some of the manufacturing base in the United States. And so I think that's probably one of the things in the marketplace that's misplaced. And I think Scott would be very happy to see the dollar weaken.
Yeah, I mean, he's a macro guy at heart. He understands the game, and a weak dollar means not only do the US is able to export more goods, but global growth picks up, and we
Absolutely.
need a global growth cycle. We'll come on to China in a bit. Also, Steve Mirren has talked about the same thing.
Yeah.
He's been very clear on this desire for the weaker dollar. And if we go back to the previous Trump administration, 2017, first thing they did was weaken the dollar.
Right. So as a global equity investor, that's very exciting for me.
Yeah, that really offers up opportunities.
Yeah.
One of the things normally a weaker dollar kicks off is a commodity cycle.
Yeah.
Is that something that's on your radar screen as well?
Yeah, I mean, you're talking about the need for electricity in the United States, and electrification needs copper. And if you look at commodity prices generally relative to the price levels relative to the market, it's underperformed tremendously. And so commodities generally, mainly copper, is very interesting for us. A lot of those stocks have generally underperformed more recently. And that's an area that we probably have about 10% of our portfolio. And they're mainly non-U.S. Copper producers. Most of the copper producers in the United States are a bit expensive, but some of the non-U.S. copper producers are very interesting.
And are we seeing yet the demand for copper, or are we waiting for the demand to materialize when China and Europe and everybody starts picking up? Where are we in that cycle?
Yeah, China's been the real drag on copper because obviously the demand for copper, the growth in the demand for copper has come from China, mainly through infrastructure. And obviously they need to move to more of a consumption economy. And the fact that they've slowed down so much has put pressure on the copper price. But I think electrification and the need for copper and electrification and energy production is going to start picking up. And even if the Chinese economy stabilizes, it takes too long to get copper production in place. We're not spending enough money around the world to put it in place. And even if you look at reasonable demand estimates for copper going forward, we don't have anywhere near the supply at these price levels. And it takes 15 or 20 years for some of these projects to get up to speed. So I think even though there's a bit of a surplus today, you're going to find out in the next 2 or 3 years that you're actually going to have a shortage of copper, and it'll cause price adjustments, and then you'll get the production. There's some really interesting copper deposits in the United States that can be tapped with better regulations and higher pricing. So it's not that the copper's not there. It just has to be accessed, and higher prices are needed to access it.
And these long cycles in things like copper mean that it's investable for somebody like yourself because you've got a structural trend that takes a while to play out.
Correct. Yeah, that's correct.
So how are you thinking through China right now? Because that's, seems to be a debt deflation going on. It's not a surprise to many of us because it's been around for a while, but they need to stimulate. Something needs to change because we need them as part of the global economy, even though we're sort of fighting with them over tariffs, but we all need that leg of the demand stool. What's your What's your thinking on China right now?
Yeah, well, we have a long history of investing in China and Hong Kong, as you probably know. I mean, we were coming out of the financial crisis in the '90s. We were the largest investor in Hong Kong. I remember one of my first overseas trips was with Dr. Mark Mobius to Hong Kong. We went into China to look at watch manufacturers, a couple of which didn't even exist. We were told about facilities and went there to look at them, and they weren't even there. So, it's a long history of going to China, looking at China, and trying to figure the Chinese market out. About 2 years ago, I think most people thought China was uninvestable, and particularly beginning of 2024 with the problems associated with Taiwan. I think today that's changed a bit, and people, because the market has turned around a bit, people are starting, and they realize it's part of an index. People are starting to put some cash in there. But look, I sit on a board in Europe that had money in Russia when Russia invaded Ukraine, and those assets went to zero. And if China makes any approach to Taiwan, those Chinese assets that you have in your portfolio are going to go to zero because you just won't be able to trade them. And I think that's the risk. Is it a large risk? No. But is it a 25-30% risk? Maybe. Maybe some people think that's a large risk. So if you're going to look at China, you have to take that into consideration. Up until, I'd say today, there's so many other opportunities around the world that are cheap that you don't necessarily have to take that risk in China. So we only have about 5% of our portfolio invested in China, but most people have much higher level of that indirectly exposed to China, and they don't even know it. If you invest in, BMW as an example, 40% of their business comes from the Chinese market. You mentioned copper and the copper demand and the impact that has on pricing. So I believe that there are enough ideas around the world outside of China that you don't have to have, a large investment in China. But there are some investments in China that are so interesting, that are so cheap, that they're worth looking at. Having said that, in Asia, most ideas that we're finding today in the Japanese market are cheaper with better catalysts than the ideas in China. So I'm sort of avoiding answering the question a bit because
You're not sure.
Yeah, I think that, who knows what the Chinese are going to do with Taiwan. If they invade Taiwan, all bets are off. Your investments go to zero.
My working hypothesis on that came up at a Global Macro Investor Roundtable last year, is that the game theory suggests that there can't be a conflict because it's too catastrophic, not only from the kinetic war thing, but TSMC.
Yeah.
Right now with AGI, at the dawn of AGI, this is far too important for everybody.
Including
really
China.
The answer's got to be what the UK kind of did with Hong Kong and the US, and everybody needs to say, look, you can have Taiwan, but the 3 TSMC plants in Arizona need to get built, the one in Germany, the one in Japan, and everyone kind of just goes their own way quietly.
Yeah. Yeah, I agree with that. I mean, China does not have an aggressive history. I would, argue, I'm not an American and I love America. It's the greatest country in the world, but, America has more of an aggressive international policy than the Chinese do. And America's been more active militarily overseas than the Chinese have. And so, my belief is that the Chinese won't attack it militarily, but that is a risk. But I do agree with you. I mean, 100% of, or 90% of all of the most advanced chips in the world are produced in Taiwan. And, but it, and you got to believe that if the Chinese invade Taiwan, that those facilities won't be scuttled to some extent. There's no way in the world you could have the Chinese control, over 90% of the advanced chip production in the world. So, but that would be very detrimental to the Chinese as well. I mean, it's detrimental to the world. And if that happened and the world went into, some sort of depression because we didn't have chips anywhere, that's incredibly bad for the Chinese as well. And, I think the Chinese really need to get their economy growing. They need stability in their economy, and they need that to control the place politically. So logic tells me that it doesn't make any sense for them to invade, and there needs to be a political solution. But if the political solution is what you've just recommended, then all these manufacturers of chip facilities must be incredible buys, because we have to duplicate that capacity around the world. Now, we started it to a certain extent, but we're nowhere near where it needs to be. And it's going to take, 3 to 6 years to get that done.
Yeah, I don't see another solution. So it just kind of feels like the obvious trade, because anything else is so suboptimal for the world that we don't go there. And what kind of opportunities are you seeing in Japan? Is that on the kind of industrial manufacturing side, or is it, what are you seeing there in Japan?
Well, it's one of the few or only countries in the world where the stock exchange itself is acting like an agitating shareholder. So basically, the stock exchange is mandated that companies trading below book value have to show how they're going to get their returns on capital up above their cost of capital, or they're going to be delisted. And we went through a process at the end of last year where they actually did that. They started delisting companies. And so you have the stock exchange itself agitating for change, which is really quite amazing. You have something like 40% of all companies in Japan trading below book value. And despite the fact that that the market hasn't done well, people don't realize that over the last 15 years, earnings growth in Japan has actually been better than earnings growth in America. And it's just because the multiples have contracted and also the currency's weakened that your returns have been much lower. But because of this agitation that's going on, you're getting Japanese companies that are returning cash to shareholders, and you're getting more M&A activity. You're despite the fact that they're returning cash to shareholders, cash still continues to build up on balance sheets. So when you ask, what are we focusing on? We're focusing on those companies that have the greatest ability to return cash to us as shareholders. So those companies below book value who have the greatest opportunity to increase their returns on capital above their cost of capital. And, we just bought a whole basket of stocks in Japan where they have leased assets on there. A lot of companies there have excess real estate, and a lot of the real estate they don't use for manufacturing or service facilities. And as a result, they lease it out. It's not booked properly, and not looked at properly when people value the companies. And if you looked at some of these companies, the lease assets in their portfolios is 70 or 80% of the stock price. And these are assets that could be spun out at some point in time. So you basically have this massive change in Japan, in a country where earnings have been doing well, returns on capital have been improving. And you got the stock exchange itself agitating for change. And it's a lot of domestic companies as opposed to a lot of export companies. But it's very eclectic. It's basically companies that are cheap relative to book, companies that are cheap relative to assets on property, properly reflected on their balance sheets, where there's agitation for change.
And is it realizable value? Does the market actually reprice these things, or does it remain cheap?
Yeah, absolutely. I think we're investing in a company today where they have a plan to distribute $350 million of capital back to shareholders. If they don't do that, the entire market cap of the company will be covered by net cash in 3 years. And this is a company that's making money and selling products around the world to a lot of different manufacturers. And they have a plan to do this. And even when they do this, they'll still have, and that's about 60% of the market cap of the company. Because of the distributions that are being made and the share buybacks that are being made, and the amount of shareholders that are going in and demanding change in Japan, these are very investable companies with real catalysts and real change that are occurring. And it's very exciting. I think it's one of the most interesting non-US markets in the world today.
And it's also the right time in the cycle as well. As global growth starts finally to pick up again, Japan usually is the outperformer from the cyclicality perspective as well.
And you have an incredibly weak currency as well. Incredibly weak currency. Now you've got a lot of issues in Japan. The biggest probably, which would be debt, particularly government debt. But you do have cheap currency, cheap assets, and a lot of big change that's going on. And so it's a fantastic market. When I used to go to Japan in the 80s and late 80s, if you asked somebody what their cost of capital was, first of all, they wouldn't even know what cost of capital was, much less what it was for themselves. And today, the emphasis on return on capital and understanding what your return on capital is and your cost of capital is. It seems basic, but it's a big driving force in Japan.
How much of a basket case is Europe? Because this is the age-old value trap, right? Europe's been a pig of a trade for a while. How are you thinking through this one?
I just came back from London, what's today, Thursday, so Monday, I guess I came back. And, it was interesting to see that market come down with Brexit and then come down again with COVID. And then it got down to, unbelievably cheap levels. If you want to know about the problems with Europe, you just have to need the Draghi report. I think it was an interesting report, but I don't think he said anything there that none of us don't know. There's too many regulations. I tried once to buy a small piece of land in Italy. Just getting your documents notarized in Italy is just an unbelievable process. It takes 10 minutes in the Caymans or in the Bahamas where you just go into a lawyer's office and you notarize it. In Italy, you have to get the document in Italian and in English. You go to a notary office, which is a government office. They read every single page in Italian, then they read every single page in English. Then you have to sign it. Then you go on to the next page. So it's a mindset that they've lived with for so long that it's going to take a while to turn it around. Mainland Europe is a bit of a mess. I'm actually quite hopeful about the UK. I think the UK has a lot of world-class companies. Something like only 15 or 20% of all the revenue generated by UK companies actually come from the UK. The rest comes from around the world. And so they've been forced to be fairly competitive. You've got a lot of world-class companies there in the energy sector that have been beaten up. In the pharmaceutical sector, you've got some world-class packaging companies based in Ireland. So look, I think they're better ideas. In a global portfolio, if you look outside the United States, I'd say the UK and Japan are probably the two markets that are the cheapest with the greatest amount of potential. I think Europe is cheap, but Europe ex-UK is cheap, but it doesn't have the same amount of potential.
The only trade that seems doable still in Europe appears to be the defense stocks. Although that's getting more expensive.
Yeah, but they've run. I've been looking at those. I went to presentations, 2 years ago and again last year in Paris by some of these manufacturers. And they definitely need to spend money. People are waking up to the fact that, the United States is not going to only come to their defense, but maybe a lot of this American equipment that they have for their defense can actually be controlled by the Americans. There's this theory that maybe a lot of the equipment has cutoff switches or, and even some of the nuclear arsenal in the UK is all maintained by the Americans. So I think there's an enormous amount of money that needs to be spent in that area. Generally, money flows tend to drive returns, but those stocks seem like they run ahead of themselves a bit.
In the US, we've talked about some of the sectors in the US. What's interesting for you there? Or are you trying to avoid the US because the dollar has to weaken, stuff like that? How are you thinking through the US? Because it's been so dominant for so many people.
Yeah, America's now, 75% of the world index?
It's incredible, right?
Yeah. And in a global equity long-only portfolio, I have 20%, which people think is crazy. In a hedge fund, I have 10% because I can short out some things as well. And people think that's crazy as well. It kind of reminds me of Japan. In the late 1980s, Japan represented 60% of the EFA index. I used to run the Templeton Foreign Fund. At one point, I went to zero in Japan, and it was 60% of the index that I was compared to.
Wow.
And people said, that's ridiculous. You're taking an enormous amount of risk. My response is, you're taking an enormous amount of risk. You're putting 40% of your portfolio in a market is expensive only because it represents 60% of the index you're compared to. And I think that's the same case in America today. Nobody wants to underweight America. America is overvalued. America is historically overvalued. America is a phenomenal place, but everything has a price. And, the amount of technology names trading over 10 times revenues today is just higher than it was during the peak of the bubble in 2000. And, the market in America could fall 40%. It still wouldn't be cheap. It would be closer to fairly valued than cheap. So, I don't think people understand the potential downside in the U.S. market. I think it's
what would be
really
the catalyst that causes that? Because it has to be a structural shift in the flow of capital out of these large technology stocks where people re-rate. I mean, we saw a bit of that in 2022 with inflation,
Sure.
but it needs to be significant inflation to stop these beasts because they generate so much free cash. How do you
Well,
stop that?
well, you've already seen start of this, I think. I mean, look at what's going on this year. You're seeing massive flows out of the U.S. into Europe. I think it should go to Asia and other places. And I think that the realization that rates aren't going back down, we never really know what the catalyst is going to be. But some of the catalysts could be rates maybe stay higher than people anticipate. Maybe, yesterday when the Fed announced that they were going to pause on the unwinding of their portfolio, I found that fascinating. Because most of the Fed at the peak owned 20% of the government debt. Now they own about 14% of the government debt. It's all at the long end. Now, are they saying it's getting more difficult to unwind their portfolio at the long end? Or are they pausing the unwinding because they know the Fed eventually, the Treasury eventually has to go to the long end because they have to roll a lot of the debt? There's so much debt in the system in the United States, and so much of it has to be rolled. Maybe it's a problem in the debt market. Maybe the bond vigilantes come back out and take control of the direction of rates. We never really know what the cause of it is, but I can assure you that in all the work that we do, we're at historically high valuations. We're, on a price to sales basis, we're well above the peak in 2000. On a price to replacement value basis, we're way above. On the cap ratio, which is the price relative to 10-year average earnings, we're well above where we've been other than going into 2022. The American market used to be a market that generated lots of free cash flow, but it was mainly tech-based. Those tech companies now have to increase their CapEx spending, and that's going to lower that free cash flow. If you look at the S&P 500, and if you take the 7 stocks in the S&P 500, the big Mag 7, in 23 and 24, those 7 stocks generated 30% plus earnings. But the other 493 stocks, earnings were down in 2023 by about 4% and up by about 3% in 2024. So basically, everything outside of the big Mag 7 stocks, the earnings have been poor. It's been the government that's been driving the economy in the United States. The government spending has to slow down. So I haven't answered your question what we're investing in yet, but I'm sort of saying that, one of the reasons why we're so undervalued there is because, why invest in stocks just because the market represents a large part of the index? You can find so many better ideas outside the country. What we are investing in the U.S. is natural gas. I mentioned natural gas. I think that's a really interesting area. We're also investing in companies that help to increase production of oil and gas because that's going to pick up. And those, although some of the natural gas companies have moved, a lot of the companies in America, world-class companies that are dominant around the world that help companies expand oil and gas production, they're looking fairly cheap. Also, gold producers don't, I'm not really a gold bug, but gold stocks don't necessarily represent anywhere near the price of gold today. There's a lot of undervalued companies there. There's some packaging companies that are really interesting. On the back of the fears of Ozempic, the dietary drug, and also what Robert F. Kennedy might do, a lot of these food stocks just got slammed. And, they may not have very great growth or any growth at all, but they're sort of becoming really interesting yield plays if, cash alternatives. So there are things to do in the United States, but when we look around the world, about 20% of our portfolio is invested long in the US. The rest is invested around the world.
So when we look at your long-only book, give me a rough idea of regional weightings and then some sort of sector weighting, just so we can kind of visualize in our heads how you're seeing the world via your portfolio. And then we'll talk about the shorts in a bit on the hedge fund side. But
so in a long-only portfolio, it's actually 22% US. It's about 14% in the UK. It's about 17% Japan.
Wow.
So UK and Japan are the two largest ones. But we have about 40% in UK Europe, but it's mainly that UK weighting. And in Asia, it's dominated by our weighting in Japan. We only have about 45 investments, and we really let our stocks drive our asset allocation.
That's right. So you're not trying to follow an index. An
Yeah.
index who's just trying to do what you do, and that
Right.
just happens to be the weighting.
Right. And, sometimes we get massive overweights or underweights in countries, not so much in industries. We tend to keep our industry weighting sort of mid-teens on the high-end basis. We also, when you look around on industries, there's this big difference between upper income individuals and middle and lower income individuals in terms of their financial stability and their ability to spend money. And so a lot of our consumer weightings have been traditionally more geared towards the upper end of that income scale because that's where the spending is. Having said that, every 10% move, I think, in the S&P impacts GDP growth by about 0.8, 0.9%. That's been working really well on the way up, but it's going to have a adverse impact on the way down. Having said that as well, I think all these, I keep telling people, all these people getting laid off in America from government work, they're all getting a year's salary. The first thing they're going to do, Raoul, is book a trip to the Cayman Islands or the Bahamas.
On the cruise ship.
Yeah. I mean, cruise ships are just, jam-packed, and when I flew into here at the beginning of the week, the airport's absolutely jam-packed. So I think you're getting this sort of mini boom from, I get laid off from my government job because of Doge. And I've got a year's worth of income. I'm going to go to the Bahamas for a couple of weeks and then come back and worry about what I'm going to do.
I mean, it's full here right now. I mean,
it's packed.
Spring break here is just like it's crazy full.
Yeah, and we have the amount of yachts we have roaming around the Bahamas too is just, it's unbelievable. I've never seen so much wealth in my life. I mean, it used to be that, people would come over here in their 25, 30-foot sports center console boat. Now, the smallest boats over here are 100 feet, and you got 150, 200, 300-foot yachts anchored everywhere. And there's an enormous amount of money at that wealth category. And I think you might see a little bit of a boom as people spend money when they get it from the government as they get laid off. But look, you can't tell me that going from 6% budget deficit to GDP to 3%, when you're pulling money out of the system, when you're sending all the illegal immigrants home. I'm not saying that any of these things are, not the right policies, but that's going to have an impact on the economics of the country. And I might have a degree in economics, which means I'm dangerous, but I would say that, stagflation is probably a real possibility at some point in the US after you see some of this money come through the system.
So on the hedge fund side, because it's a different game, how do you think about shorts? It's all well and good being underweight something. It's very different being short something. So when you're looking through the short book, what's your philosophical framework for what you'll short?
Yeah.
Is it the relative underperformance, or you're looking for absolute performance on the shorts? Obviously, we all want the absolute, but it doesn't always work that way. How are you thinking of that, and what opportunities are you finding there?
Yeah. Shorting's changed a lot over the years. It used to be individual stock shorts. That's becoming very dangerous these days. So it's more baskets of shorts and indices to hedge and also, but generally, when we look at shorts, we're doing individual company shorts. We're doing shorts that are associated with arbitrage positions. So you have share class arbitrage, you have holding company arbitrage, and I would say the vast majority of our shorts have been associated somehow with some kind of arbitrage position. If you have a company that, I won't name the company, but if you have a company in Asia and it holds listed companies, and those listed companies make up 80% of its stock price, and the remaining stub is, super interesting.
Yeah.
You can either just go long it, or you can go long it and you can short out what it owns and create that stub.
Yeah.
So the vast majority of our work historically has been non-directional, as opposed to directional shorts. And most of the directional shorts have moved from stock specific to more indexes. But look, I think that the indexes are the way to protect yourself these days, because the indexes are so expensive. And it's, if you just wait for opportunities in the market in terms of volatility and do it right, you can basically, you've had an opportunity to have great index shorts in place to offset some of the stuff you're doing. Technology is a great example. We have a list of, we're short a basket of stocks in the technology space that all trade over 10 times revenue. 70% of them don't make any money. They trade, we feel that basket of stocks probably has 50 to 60% downside. Any of those individual names, we could probably go short, but we're more comfortable having it as a basket because we just feel the individual names. So the only reason why we have that basket on is because we have 4 names in our portfolio on the technology side that we think are fantastic investments. And we sort of hedged that a bit by having this basket of very expensive, loss-making technology stocks.
It's been a tough game to try and play the relative performance of value versus growth. So do you try and avoid structuring your book that way and just saying, listen, we're just trying to find value that outperforms and shorts that do a decent job for us, as opposed to ending up fighting the war, which is a war that has been very painful for a lot of people to fight?
Yeah, we're not going long value and shorting growth. That would, I'd be raking beaches in the Bahamas if, I had that trade on. I might be raking beaches in the Bahamas. It's not a bad job, I don't think, actually.
It's not terrible.
Yeah. So yeah, we don't try to play that relative game at all. We're on directional shorts, company specific shorts. We're trying to find problems with companies that aren't reflected in the stock price. And there's a fair number of those, but, sometimes they can run much longer than you think. You have to be very careful with those. And we try to use options as much as we can, as opposed to shorting outright, because then obviously we limit our downside. The other thing that's interesting too is from a hedging perspective, we're 80% now or 78% non-US in terms of our exposure. But with the differences in interest rates around the world today, you don't have to take that currency risk as well. So there's an awful lot of hedging that can be done from a currency perspective. And in most cases around the world today, you get paid, in fact, in the forward market to hedge away most of your currency. So we do a fair amount of hedging there. And there's also, you have companies listed on 2 different exchanges, and sometimes they share different share classes. The values of those blow apart for different reasons. Sometimes we'll be able to take advantage of that. But in most cases, we have an upside and a downside for every stock we invest in. If I'm right, how much money am I going to make? And if I'm wrong, how much money am I going to lose? If you try to buy stocks that are sort of 4-to-1 upside, you don't have to be right more than 50% of the time. But you can also use options or short positions to try to achieve those targets as well. So I would say that most of the shorting that we do is conservative in nature and tries to reduce risk in the portfolio.
And what about, you've had a small and very loyal, steady investor base, but have investors lost the love of value investing? How's that? What's the mindset of the investor? Because, it's all well and good. Yeah. You've done your homework. You've been doing this for years, but investors are also a fickle bunch sometimes.
Yeah, they are. I remember when I ran the Templeton Foreign Fund, I tied Peter Lynch for outperforming the index for a certain number of years. And then in 1998, when Asia was collapsing and I was buying, Singapore Airlines below the cost of its aircraft and getting the business for free, and it kept going down. I think it was flat and the U.S. market was up quite a lot. And, we had net redemptions from the Templeton Foreign Fund for the first time. And I was sort of shocked, and Barron's wrote an article, portfolio manager falls off the mountain. And then in 1999, I think we were up over 30%, and Barron's wrote an article called Portfolio Manager Comes In Out of the Cold. And, it was nothing that we did in 1999. It was everything that we did in 1998 to sort of set ourselves up. I only say that because, it was also one of the reasons why I decided I wanted to go off on my own, because I was sort of shocked that, you outperformed for, from 85 until 98. And, and then you have 1 year where you didn't lose a lot of money. And, all of a sudden a lot of people leave. And being a competitive person, that sort of, hits you right between the eyes. So yeah, it's been a rough go for people in the value space, but I would say there's an enormous amount of interest in value today. And there was an enormous amount of interest in value last year, but nobody really wanted to commit to it. Nobody really wanted to be the first one to miss out on that. But that's changing quite rapidly. I did a call last night with, a massive pension fund that is looking to increase their allocation to global value money managers. Raoul, there are not a lot of people in the value space that have been around 20 or 30 years.
The only one, do you know Des Kinch?
Sure.
Yeah, Des is my neighbor here on Little Cayman.
And a lot of people that are in the value space, they sort of slipped into the growth space, because they had to.
Yeah.
A large portion of the money we manage are our own, so that gives us the luxury of sticking to our knitting. But I really think, and the numbers will show it, that value turned around when the 10-year turned around 3 years ago.
That's
and okay,
right.
You could say last year that wasn't the case, but last year I think was abnormal because of the election and all the liquidity that went into the system because of the election. And, growth has been a liquidity and a difference in growth game. And the amount of liquidity that was thrown into the system last year prior to the election was just unprecedented. So I think it was a blip, and I think value has already turned around.
I just think it's wrong to also think of it as value versus growth. It's like if you are a large pension plan, you should have an allocation to both, and they're different things. They give you different return profiles, different streams, and that's okay too. But there's people have this thing in their head, it's one versus the other. I just don't see it that way. One gives you a lot more comfort and ability to take long-term risk because of the embedded value. The other is a more momentum-based play. They're just two different things.
Well, I think a lot of people will criticize value money managers and say, look, value investing should encompass growth. And I agree, but growth became momentum investing, as you just mentioned.
Yeah.
And so I think that's been the big issue. But look, if you look at a graph of growth versus value from 1975 until the global financial crisis, value generally outperformed growth with periods of dramatic growth outperformance. But generally, value was outperforming for a long period of time. Since the global financial crisis, growth has outperformed tremendously with small periods of value outperformance, particularly 2022 and 2023, prior to the downturn last year in value versus growth. Once again, I just think that over the long run, it's a sensible approach because you're looking at, we take an intrinsic value approach. Intrinsic means unto itself. We're not buying something that's cheap relative to the market. We're buying something that we feel is cheap on an absolute basis. And if you do that, you also protect your downside quite a lot. And I think growth and value you tend to get these big readjustments in markets like this, in markets like 2022, when you have these big downdrafts, and, value tends to hold up very well in those downdrafts. And all of a sudden people look back and, your 3-year numbers and they go, wow, that's not a bad number. Well, yeah, because in 2022, we didn't, lose our shirt like a lot of growth managers did.
Mark, fascinating conversation. I really appreciate it. And let's see how this plays out going forwards. I mean, I personally am more of a growth person, but I also can't help but think that there is incredible value that's misunderstood and mispriced still. And, I'm also a business cycle guy, and it just feels like it's the right point in the business cycle that it actually, for once, then becomes much easier. Once the business cycle starts expanding, the cyclicality of this stuff is super interesting.
Yeah. Well, that's my space. I'm having a lot of fun in it. There's a lot to do. And things are not only cheap relative to growth, things are just cheap in our space. So it's a lot of fun. And I appreciate the time with you. It's been a lot of fun.
No, absolutely. I look forward to it. I haven't been to the Bahamas for a while, so I'll come at some point.
We'll come visit. Get on one of those cruise ships and come on down. So,
oh my God, no way. Never going to happen.
Yeah. Well,
all right,
it's good to see you.
Good to see you.
All right. Cheers.
So in a discussion like this, it's not for me to extend my views, but to glean as much from somebody like Mark as possible. We have a different investing approach, but Mark has an extraordinary amount of experience. And what I take away from it is where the other opportunities lie that I may not be focused on. And for you guys, not everybody wants to be a growth investor. Not everybody wants to be a crypto investor. But what you need to do is listen to the world's best investors. So I really hope you enjoy it. See you next time. Super AI. Everybody wants to know what's going on in AI. This has been the event to figure it out. You get to speak to the smartest people people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.